Okay, hi everybody, welcome back. We are going to talk a little bit in this video, a little bit more on loans. And specifically, we're just going to touch on car loans and home equity loans in this video. And just those are, especially the car loans, I think that's often one of the first loans that someone will take out as they emerge out of teenagehood and into collegehood. That car loan is a lot of times one of the first major loans that takes place. So we're going to talk about that, and in the same breath, we'll spend a little bit of time on home equity loans and touch some high points there. And just remind you to check out, if you become a member of the LifeSense community by making a donation of $35 or more, you'll have access to the video blog, which includes a growing library of videos that will have a much deeper level of information on very specific topics. So we'll be having videos there that dive a little bit deeper on car loans and home equity loans and such things that help you really do some math and calculations and that kind of thing. So anyway, just a quick preview for what's over there if you decide to make a donation and head over there. So anyway, we're going to talk about car loans and home equity. You'll see it called a HELOC a lot of times, a home equity line of credit or a home equity loan. It's really the same thing. Okay. So what are we going to learn today? I just want to make sure you kind of have a sense for where we're going. So we'll just be sure that you can identify the various types of installment loans. And these are, by the way, are called installment type loans. I'll just write that up here at the top of the page. Installment type loans, okay? We'd like you to be able to explain why installment loans cost less than rent to own. You've seen the rent to own places. You see them on TV. We'll say less than, rent to own. The rent to center kinds of places. They certainly serve a market niche, but they're not a very cost-effective way to borrow money. We're going to talk a little bit about factors lenders use to make loan decisions. We'll talk a little bit about questions you might ask when purchasing a car. That'll help you on the financing side. And we'll cover quickly some advantages and disadvantages of borrowing using your home as collateral. So we'll just advantages and disadvantages of a HELOC, because that's essentially what that is. So we're going to get started then by just defining what an installment loan is. And its name sort of gives it away, and we'll just write it up here. But installment loans are loans that are repaid in equal monthly installments. We'll just say equal monthly payments or installments for a specific period of time. Usually it's over a certain number of years. Okay, so that's just really what an installment loan means. There's two types of installment loans. We covered this in another one of the earlier videos, but there's the secured and then there's the unsecured installment loan. Secured typically are going to be loans that are secured by property, most commonly real estate like your home or your car. Unsecured loans are any other kind of loan that doesn't have any collateral, that's unsecured. Okay. Coming back to the secured for a minute, what it essentially means is a secured loan is a loan in which the borrower, or you if you're the borrower, you really give up your right in whatever collateral you put up if the loan is not paid back. So if you have put up your car as collateral for a car loan, if you don't pay it back, that car disappears. The repo man comes and takes it. That's what a repo man does. Repossession is what that's short for. And the bank sends the repo man out to collect your car, and they take it, they sell it, and they try to pay the loan off with the proceeds from that. An unsecured loan is just simply one that does not require collateral. That's as simple as that. They're harder to get, by the way. Unsecured loans, in a lot of cases, are hard to get, and they're really based off your credit history, maybe your income, but most likely, really, those unsecured loans are really going to be based off your credit history and your credit score. Okay, so the cost of installment loans. We started to talk a little bit about this in an earlier video. We've got what we call the APR, the annual percentage rate, which is really the interest rate that someone, the bank says they're going to charge you, plus the fees and costs of that loan all kind of rolled together. So, when they add the interest rate, it may be a 5% interest rate, but by the time that they add the fees and costs associated with that loan together and kind of munch that into the loan and, really consider these to be additional interest, if you will, that's where you come up with the annual percentage rate. So that's the APR is really the true rate of interest or the true cost of the loan. Not really the true rate of interest, but the true cost of the loan, because it does include these fees and costs. There's different types of loans. There's a fixed rate loan, which is what it sounds like. It means your interest rate stays the same over the full period of the loan. There's a variable rate loan is really the second type of loan here, and that's one where the interest rate floats or may float or change over the term of the loan. If you've listened to the news and you've heard about ARMs, you may have heard about ARMs. That's just simply called an adjustable rate mortgage. So in the homeowner's sense, an ARM is a variable rate loan. And then you've heard maybe somebody refer to as a 30-year fixed. All right, so that's a fixed rate loan where the rate is fixed for 30 years. Okay, so really two different types, fixed and variable, and it's just very important to know which one of those you're getting into when you go for a loan. And then, of course, don't forget that there are always going to be finance charges associated with loans. That's both up front when you go for the loan, but also, if you're late with any sort of payment, chances are they're going to hit you with some sort of a finance charge for that late payment. So just know that if you're late, that that loan will start to cost you even more. So the next thing we're going to talk about a little bit is just a little more detail on financing a car loan. So again, you're going to use the loan. So you're going to use the money from the loan to buy the car. The car becomes collateral for the loan, and the lender holds the title. Okay, so even though you have the car, if you look carefully at your title, it'll show, let's just say that you go to U.S. Bank, for your loan. If you go to U.S. Bank for your loan, on the back of the title, it will actually list them as a lien holder. Okay, and they actually have an interest in that vehicle. Again, if you default on the loan, they are going to come back and take the car and repossess it because they have an interest in it, and that interest is reflected on the title where they are listed as a lien holder. Okay, that's how you can always tell if a car has clear title or not. You just look at the place where it talks about the lien holders, and if someone's listed, that means that there's somebody that's got an interest in that vehicle. Okay, new car loans are typically 3 to 7 years in length. Used car loans are more likely to be 2 to 5. Now, notice when you go to a car dealership, a lot of times they will try to decide, help you figure out what payment you can afford, right? How much per month do you want to pay, right? I'll always ask you that question. Well, you have to be careful here because when they're asking you that, what they're trying to do is squeeze you into a car that maybe costs more money than you want to pay. But the longer they make the payment period, right, the closer to 7 years or 5 years that they could get, the lower the payment is going to be. It's just that you're paying it over a much longer period of time, which also means you're going to pay a lot more interest. So lower payment probably means you're paying for more months and more total interest because you're paying that car loan over a longer period of time. So you're going to end up paying a whole lot more interest. Well, who's going to give you a loan for a car? We talked about banks. That's one. Credit unions are pretty popular for car loans. car dealerships themselves may provide financing. Okay, so when you are ready, you found the car you want, it's time to get a loan. The first thing that you're going to go through is some sort of a pre-approval process. And this is free. Fill out an application. They will process your application. The only thing to be aware of is when they do this, this is going to be a hit on your credit report. Now, it's not necessarily negative because they're not reporting you as being delinquent or anything like that. But just know, and this is covered a little bit more in detail in our video on credits, but the more people who you give authority to go check your credit, okay, those are called hard, I can't remember the exact word, but I think they're called hard requests. If you get too many of those in a short period of time, it will actually impact your credit score. So you want to be a little bit careful about just going to 10 or 12 different car dealerships and having them all process your loan paperwork, or a loan pre-approval, because that'll have a negative effect on your credit. You want to be kind of selective about it and just really almost limit it to the very last one, your very last choice. And by the way, when they run this pre-approval, it doesn't obligate you, or it shouldn't. Just obviously be careful about everything, but it doesn't obligate you to actually take out a loan. Okay, I think that's primarily what I wanted to cover in this video. We'll have more follow-up videos on the blog when it comes to car loans and that kind of thing. We'll go into a little bit more detail, but I think this is a good start. Okay, thanks very much. We'll see you later.